All right. Good morning, Becky. How are you?
Good morning. I'm doing good.
Fairly
How are you?
good. What's that?
How are you?
I'm doing okay. Yeah, doing okay. I tell you what, I don't know what you were like this morning, but man, I didn't want to get up. It's so cool in the morning and it's dark and man, it's good sleeping weather. Well, I'm glad you could join me. Anyway, we're going to start chapter 6 today. So I'm going to go ahead and start the share. We might as well get right to it. And I'll switch the display. Okay, chapter 6 is about accounting for cash. Yeah, I would also include controlling cash, make sure that, you don't lose it. It's not stolen from you, and how to prevent fraud. And also we're going to be talking about internal controls in general. And internal controls are just ways that we protect our assets. And so I'm going to kind of flip the way the book does it. I'm going to be doing technical things like how to solve problems with the numbers and number crunching today, so that you can, when you get to the homework, you can do it right away. And then the next session, I'll go ahead and do internal controls. But I wanted to do the number crunching first because I don't want you to have trouble, trying to get the answers. The internal controls is a soft subject, right? It's more conceptual, but some of the other, like the bank reconciliation, I got to show you how to do that. So, okay, let's talk about it. Objective P1, apply internal control to cash receipts and payments. And we're going to talk a little bit more about that in detail later. But in general, for cash receipts, we want to make sure that nobody can make a mistake or divert cash without the difference being revealed. Okay, so in other words, we're trying to catch mistakes that are unintentional, but even intentional irregularities, such as embezzlement, right? Well, look at this, how this flows. We have a sales department, and the clerk is going to ring up the cash sales on the register, which is good, like point of sale. And then the clerk's going to prepare a count sheet, right? Now, the clerk is going to keep a copy for herself, but also going to send the cash and the cash sheet to the cashier. Okay, so then what the cashier is going to do is, of course, count the cash, and he or she will review the cash sheet that was submitted by the sales department, make sure they agree, but also he's going to look at the register sheet provided by the supervisor. So what it nowadays, because the cash registers are all digital, you have all these electronic reports. In the old days, at the end of the day, you would have to open up your cash register and pull the tape, and it would show the day's sales and how much cash you should have. Nowadays, they just send it electronically. So anyway, the supervisor is going to send that register sheet to the cashier, and the cashier is going to match everything up. The dollar amount of actual cash, the cash that the sales department said that they sent over, and then also what the supervisor said should be per the cash register. And then the cashier will prepare the cash records and deposit slip and make the deposit. It says, and journal entry. I don't think that's right. I should probably even talk to the author about this, because those that control the actual cash should not make the journal entry, right? That's kind of like segregation of duties. So we'll talk about that later. But anyway, you can see here that there's a control. Not one person is just going to take the cash and deposit it. Somebody else is looking at it and checking it. Matter of fact, that after the cash is deposited, we're probably going to have the treasurer kind of look at the bank statement that we're going to be talking about, which is a record of what the bank says was deposited, and compare it to all these other sheets of cash sheet and the register sheet to make sure that no cash was missing. So it's all part of that, those controls that will make sure that we're not going to lose our cash. All right. Now, sometimes errors are made by the cashiers. And I don't know, I'm sure that in a big class as ours, some of you were probably a cashier. And so at the end of your shift, you're supposed to count your drawer, and by golly, you might be short some days and might be over other days. Now, if the amount is small, well, that's just the way it goes. If it's large, the managers are going to take a look at you and say, well, what's going on? Why are you short, or why are you over? Are you not doing your job? Okay. But it's typical that sometimes, your drawer will be short or over. If it's short, you probably gave out too much change. And if it's over, you probably didn't get enough change. And I've heard of managers actually doing this, going to your drawer and slipping in a $20 bill and see what's going to happen at the end of the shift. If you take the money to balance your drawer, you'll be fired, because that's what the manager is trying to do. Just, well, are you honest? Because you should be over $20. Because why? Because the manager planted it there. Well, anyway, how do we handle these small miscellaneous shorts and overs from the cash drawer? Well, I'm going to offer you this example. If a cash register's record shows $550, right? So we think we should have sales of $550, but the count of cash in the register is $555. We would prepare this entry. Well, we counted 555. So because that's the actual cash, we are going to debit cash for what we really counted, the actual cash, 555. And then we're going to credit sales for what the cash register said. I have this cash register tape. I guess I'm just old school, right? Because now it wouldn't be a tape. It'd probably just be an electronic report. But anyway, what the cash register says you have is what you put here. The difference between what the actual cash you have and what the cash register says that you have, the plug would be to account called cash over and short. That's a plug. So 555 debit of cash, right? Minus the sales of 550. Well, we're actually over by $5. Matter of fact, I'm going to train you this. When you see a credit balance in cash over and short, you are over. Okay. Let's take another one here. On the other hand, let's say the cash register shows 625. Okay, fine. So we'll put sales of 625 because that's what the cash register says. But the count of cash in the actual register itself is 621. So that's where you would debit cash, 621, the actual cash. The difference between your actual cash and the amount of sales and cash that the cash register says that you should have is taken to cash over and short. You plug it. In this case, you're plugging it with a debit. How do I get that? Well, 625 minus 621 is 4. Now, when you see a debit of cash over and short, that means that that's a short. And that kind of makes sense, right? You only have 621, but the register says that you should have had 625. So you're short 4. Now, let me teach you a way to remember this by asking you these two questions. If there is a debit balance in cash over and short, Are we short or over? Well, this is how I remember it. If you have a debit balance, well, a debit is an expense. So remember, you think debit, think expense. Well, then that's miscellaneous expense, and that means you're short. So a debit balance and cash over and short means that you're short. It's an expense and you're short. How about a credit balance in cash over and short? Are we short? Are we over? Well, if we have a credit, you're thinking miscellaneous revenue. Remember, revenues are credits, right? So if you see that credit, you know it's a revenue. That means you are over. That's how I remember it. Okay. I left the door open here, my office, so my dog can come in and out, because it's kind of makes the house a little bit cooler and my room cooler. Hopefully he won't start going crazy on us when the delivery guy comes, because he loves to bark at the UPS guy. Anyway, let's give an example of cash over and short. At the end of the day, a cashier counted his drawer. He made 2,500 in sales for the day. So it's funny, this question is, he counted 2,500 cash. However, the cash register machine record indicated that 2,498 sales were made. What is the journal entry to record the sales for each day? Well, we counted $2,500 in the till, right? So we're going to debit cash of 2,500. That's the actual cash counted, right? Debit to cash is the actual cash counted in the till. Now, the cash register said that we should have had 2,498. So sales is what the cash register report says, right? Of 2,498. So we should have had sales of 2,498, but we counted 2,500. So to plug that, we plug it with a credit. And because it's a credit, that's that credit to cash over and short, we're over. We're over. Yeah, we should have had 2,498, but we're over $2. We counted 2,500. Okay, so that's kind of how it works. All righty. Let's talk about cash receipts by mail. When two people, well, when you're in the mailroom, they recommend that two people are assigned the task of opening the mail. Why do we have two people in the mailroom? Why not just one? Well, when cash comes in, if you have one person, they could just say, you know what? Nobody's looking. I'm going to take the cash, right? But if two people are there, the only way that they could circumvent the system, if both of them are dishonest, hey, let's just rip them off because we can, let's rip our company off. So that's why we put two people in there. What will happen then, the two people in the mailroom will count the cash, and they will send the cash with a cash report to the cashier. And then the cashier will deposit the cash in the bank. Now, the record keeper will receive, we're talking about the accounting department now. The accounting department, the record keeper will receive a copy of the cash report without the cash, right? Matter of fact, that's one thing that we're going to remember. The people that handle the cash and the people that record the cash, well, the people that record the cash should not be handling it, right? The record keepers should not be handling it. That's a good counting control. Okay. So then basically the bank balance, which is on the bank statement that we're going to be talking about in just a second, has the deposit that's listed. And so that person, probably the treasurer, will compare what the bank says to what was recorded, right? And matter of fact, that treasurer will probably agree the records from everybody. That treasurer will probably look at the cash report, and the treasurer will also look at the journal entry and compare with the bank statement and make sure that the actual cash that flowed through the company actually made it into the bank. Okay, so that's good cash receipts. This was usually a test question too. How many people should be in the mailroom? 2 people for good counting control. Now let's talk about control of cash disbursements. And this control of cash is trying to control like theft and just of payments, and also payment to fictitious invoices. And I guess I can show you what they do, how you can circumvent the system to embezzle the company. You can do it, but usually you'll get caught if you have good accounting controls. Okay, some of the keys to controlling cash disbursements is this: all expenditures need to be made by check. So you just don't have wads of cash and paying your bills with cash. You do it by check. You know, there's a lot of control with a check, right? Because you have the check, it flows through the bank. So the bank has a record of it. You have a record of it in your accounting records. And also, not everybody can write checks, right? You need to limit the access to the checks. And so only those who have authority to sign the checks have access to those checks. So that's big. Can require all expenditures to be made by check. Another thing I'm not really going to cover is kind of a voucher system. And basically, it's just having approval of expenditures before expenditures made. So you'll actually see like the supervisor signing off on it. Yeah, it's okay to pay this. And then it'll be paid by check. But that's how we control disbursements, right? Well, let's talk about, accounting for cash. And specifically, we're going to talk about the petty cash fund, the petty cash fund. Now, the petty cash fund is used to pay small amounts. Okay, so I wish I had a little box. Yeah, I don't have a little box. Well, I'll do this. Pretend this is a big box. It has money in it, right? Okay, first off, what we're going to do is we're going to establish a petty cash fund. And so what do? To establish it, we're going to write a check to cash. And so we take $100 out of our, like a checking account, and put it, the actual hard cash, into the petty cash box. So to establish the fund, we debit petty cash and credit cash. So right now we've got $100 in this box. Now we're going to assign one person to be responsible for that $100 and who gets paid on it, right? So what will happen is, if you want some of this money, hey, you want some of this money? You have to come through me. You say, look, I need to go down to the post office and buy some stamps. Can you give me $20? Okay. And I'll actually have you fill out this voucher. And so you'll say, I'm taking $20 and it's for stamps. You give me the voucher, I put it in the box, then I give you the $20. At any time, I can count the cash and the vouchers that, the money that I've given out, and it should equal $100. But anyway, so we'll be making payments from the fund. Now, eventually, we're going to have more vouchers than cash in here, right? So we need to replenish the fund. And this is how we're going to do it. We're going to record all the reasons why we gave out the amount. For instance, I gave you $20 for postage, so I'm going to put that in. And then there's some miscellaneous expense, travel expense, and then we're going to credit cash. And that's how we replenish the fund. And you're thinking to yourself, or maybe you're not, but you should be thinking, hey, man, if we're replenishing the fund, shouldn't we be debiting petty cash? We're putting money in. Where's my debit to petty cash? Well, that would be a good observation. You're probably thinking to yourself, I never even thought of that, but now that you mention it, where is petty cash when I replenish the fund? Well, actually, this journal entry here is really combining two different things, making the payments and replenishing the fund at the same time. And now you're saying, Tetra, you are really confusing me, but check this out. Let me give you this a simple example. Let's say that you come and now this time you want $25. Okay, so I'll give you $25 out of the box, and the voucher will be for postage expense. And so now eventually I'm going to, debit postage expense, right? So that's another, you would know that, right? You take money out of the box and what's it for? It's for postage expense. So debit, postage expense, credit, petty cash. You can see that the money goes out, you record the expense. Now, let's say I want to put money back into the box. Well, the way I've taught you, you would think, okay, well then you're going to debit petty cash for $25, right? And credit cash for $25. It's coming out of our regular cash account, our checking account, and we're going to put it in the box. That kind of makes sense. Okay, so now you're thinking, okay, Tetra, I follow that, but how does that relate to the journal entry before that for replenishing it? Are you ready to be amazed? Ready? I know. Well, if this excites you, then you're a true accountant. If not, I totally understand. But check this out. The replenish entry is actually two entries in one. You're taking the money out of the box and you're putting the money back in the box. What do you have left? Debit, postage expense, 25, cash, 25. It's the net of the two. That's why it works. Okay. Well, if you want, you can kind of study that, but that's because I remember thinking, why is that? And you say, well, Tetra, why do we do it that way? Why don't we just do it, these two separate entries? I'll tell you why. That petty cash is a very small amount. And we call that petty cash an impressed fund. So once you establish petty cash, you don't touch petty cash again. You never do, unless you want to increase what you want in the box, or you want to decrease what's in the box. But if you want to keep it at $100, then you never debit or credit petty cash ever again. And you do it this way, where you have the two entries in one. Okay. Now, speaking of that, if you say, well, you know what, $100 is not enough to put in the box. I mean, people are coming in all the time and I just need a little more to be safe. Well, if you want to increase the petty cash fund, go ahead. Then you can touch it and go debit petty cash 25 and credit cash 25. Just like when you established it, now you're making it a little more. But also, if you say, God, that's too much, $100 is, or it actually says decrease petty cash fund from 75 to 55. Okay, you have 75 in there, but you only want 55. You want to decrease the petty cash. Well, go ahead and you're going to credit petty cash and then take that money out of the box and put it back into cash. Okay. So other than that, if you don't want to increase the fund, the money that's in the box, or you don't want to decrease it, you're going to leave petty cash alone. You will never debit or credit petty cash again. Okay, let's do a more complex example, something that you might see on your homework. On June 1, a petty cash fund was established for $200, and the following receipts were issued during June. Okay, so let's establish the fund, right? That's what we're going to do on June 1, establish the fund. Well, this is super easy. So on June 1, we're going to debit petty cash for 200 and credit cash 200. Yeah, we're going to write a check against the checking account and put the money and convert it into dollars, right? And put the money in the petty cash box. Debit petty cash 200, credit petty cash 200. Now, along the way in June, we're going to pass out money. And of course, we're going to have the people fill out those vouchers so we know why we issued the money. We issued $50 for freight expense. We issued $35 for some office supplies, $3 for postage expense, and even some travel expenses for $40. Now, how much did we actually disperse? Well, if you add all that up, we dispersed $128, right? Now, we find out down here that the fund contains $70 cash. So how much do we, if we have $70 cash in the box, how much do we need to replenish? Well, if there's 70 in the box and we needed to get back up to 200, right? We need $130, right? Because 70 plus 130 would get us back to the 200. But what the heck? We need $130 to replenish, but we only dispersed 128. We're short, right? So we're missing $2 somewhere. Okay, it's a small amount, no problem. How are we going to handle that? Well, just like we would normally, we would take all of the reasons why we disperse the money and list them. Freight out, $50. Office supplies, $35. Postage expense, $3. Travel expense, $40. Okay. Now, leave a blank. I already have the answer here, but leave the blank. And down here, how much cash do we need to replenish it? Well, I said it'd be 130. Why? Because we need to get it back to 200, and we only have $70 in the box, right? It told us that we need 170 in the box. Well, the thing is, we've got 128 of debits here, right? Because this is what we actually distributed. We have 128 debits, but we have 130 credits. So we plug it by 2. And that plug is to cash over in short. And that means we're short. And that makes sense, right? We dispersed 128, but yet we need 130 to replenish it. We're short $2. Well, we just plug it to make it work. Things happen. Okay. Any questions about that? I'm going to give you just one more example. We established a petty cash fund of $150. Let's go ahead and do that right now. Establish debit petty cash, 150, credit cash, 150. Now, we have to figure out, how much our reimbursement is going to be. Okay, so we have this information, right? Right now, the fund reached a balance of $19 cash. Well, if we reach $19 cash and we need to replenish it to 150, so we know that 150 minus 19 is 131. Because there's only $19 in the box, we need 131 to get it back to 150. So we know that we're going to be, putting cash in of 131. Now let's go ahead and put in all of our reasons why we distribute the money. Delivery expense, 29. Merchandise inventory, 18. Now, this is funny. They kind of screwed up. They forgot what account was being charged. Well, we're going to do, we don't know what it is. We forgot it. Okay, fine. We'll just include that amount as miscellaneous expense. So we're going to add the 32 and the 41 together. That's going to be $73 to miscellaneous expense. Okay. So now we've accounted for that. This amount here equals $120. 29 plus 18 plus 73 is $120. Yet, like I was telling you, we need to replenish the fund by 131, right? Why? Because we have $19 in the box. We need to replenish it to 150. So we need 131. Well, wait a minute. We only have 120 of disbursements that we can count on, right? 120 of these, but yet we have to replenish it for 131. Well, we're short. So we're going to plug it by 11. Okay. Any questions about that? I hope those two examples helped you, because on the homework, this is the most complex one, right? With the cash short and over account. All right, I got to ask you a question. We have this information here, and we established the fund, and then we replenished the fund. That's fine, but they ask you this next question here: what is the petty cash balance immediately before reimbursement, and what is the petty cash immediately after disbursement? Now, it said that we only have, before the reimbursement, we have $19 in the box. Is that what we have in a petty cash account in the records? No. Remember, we don't touch petty cash. So when we establish the fund, it's going to be $150. And whatever happens below, the replenishment or the taking it out of the box doesn't affect petty cash account. The only time it's going to affect it is if you want to change the actual amount of the fund. Let's say you have $100 in the box. You say, that's not enough. I need to add, 25 more. Well, then you can debit petty cash. But other than that, any activity of the money coming in or the money going out does not affect the petty cash account. Okay. All right. Let's talk about the use of a bank as a accounting control feature. A bank is a wonderful thing because it really helps protect our asset cash. And how does it do that? Number one, it minimizes the amount of currency on hand, right? So you don't have to have big wads of cash in your pocket or big wads of cash in your safe, because you can put it in the bank. And mainly you use checks for your disbursements anyway. So you don't need a large amount of currency on hand. The little cash that you have can be put in that little petty cash box that's locked up that somebody has control of. Only one person has control. Because if something goes missing, if that one person has the control of it, if something goes missing, that person is responsible. If you had a couple people taking it and using it, if something goes wrong, well, who did it? Did our employee A do it or employee B do it? We don't know. But if employee A is the sole person that's responsible, if something goes bad, employee A, you did it. That's good accounting control. We'll talk about that. Okay. Also, it provides physical controls of the storage of cash, right? So yeah, you store your money in your bank account, and the bank takes responsibility for it. And I don't know if you even think about this, but the bank actually helps create a double record of all your banking transactions, right? All your checks that you wrote and all the deposits that you made. And Why? Because the bank has the records of money coming in and money going out through their records. You have the same records, right? You have your checks written and the money that you deposit in the bank. And what's going to happen is about once a month, the bank is going to send them what they have and through a bank statement. And then you're going to look at it and compare the bank statement to your accounting records and then reconcile the difference. So it's a beautiful thing. Every business should use a bank to control their cash. Okay. Now I keep talking about this bank statement, and most of you guys probably have a bank account, and you young folks probably don't even get a physical bank statement anymore. In the olden days, before the internet, the bank had to mail the statements to you once a month. Now you can get them electronically. But if you haven't looked at your bank statement through the internet, you probably should. And if they're going to show the same thing, paper or electronically through the internet, like the B of A app or something, or the Chase app, whatever bank you use. Okay, the bank statement is just going to be a listing of all the withdrawals you made, like checks and those type of things that decreased your account, and all of the items that increased your account for a certain period, right? And then you're going to, compare it. This like bank balance to your checkbook balance. Now, there's all kinds of different transactions going here, right? Yeah, you made a deposit. You've got a printing charge, check printing. So actually, I guess you order some checks and they give you some physical checks. Now, I still write probably 3 or 4 actual checks a month, right? So mainly I do electronically now. And then there's an electronic fund transfer deposit. And check this out. It looks like collected a note. What does that mean? You can actually have the bank set up with the bank so that the people that owe you money because they signed a note, they can come in and deposit what they owe directly to the bank. Isn't that interesting? Non-sufficient funds check. They're taking that money out. Now, does that mean, my check bounced? No, what happens is you deposit a customer's check and the bank will actually give you credit for it and increase your cash balance. But then the bank, your bank, goes to your customer's bank and presents the check and said, hey, you got to pay this because your customer wrote this check. And then your customer's bank will say, he doesn't have enough money to cover that check. Whoa, your bank comes back and says, look, we can't collect on this check. We got to back it out of your account. So this is non-sufficient funds check. It's not that you bounced your check. It's that your customer bounced the check, right? All right. And then also some interest earned. Wonder what this is. Is this a checking account? What is this? I know there is interest-bearing checking accounts. I think mine is interest-bearing, one of my checking accounts. So, okay. Well, now at the end of the month, when we get the bank statement, we need to reconcile the balance on the bank statement with our records to make sure that we included everything and the bank included everything. And oftentimes the bank statement balance and your checkbook balance doesn't agree. And so what are we going to do? Let's say that we look at our bank statement balance and there's $900. They say, we've got $900. And then you're saying, hey man, the bank is trying to rip me off. I have my checkbook balance should be 1,000. They're ripping me off. They're not giving me credit for $100 bucks. What's going on? Are they trying to rip you off? No. What happens is there's timing differences. There's sometimes you put things in your checkbook that the bank doesn't know about yet or haven't given you credit for. For instance, let's say that on your checkbook, you made a deposit on December 31 at 5 o'clock p.m., right? December 31 or something. Well, you know that you made the deposit, so you included it in this amount, but the bank didn't know it and hasn't given you credit for it yet because you did it at the last minute. So you're going to give the bank benefit of the doubt because that deposit is not in the bank balance. So we add it. All right, now we're up to 1,050. Hey, you know what? I think the bank made an error in our favor. And because it's in our favor, I'm going to shut my mouth. I'm not going to say anything. No, there's another timing difference too. Let's say that you wrote a check to Sally for $50. So you know you wrote it, but Sally hasn't cashed the check yet. She's so rich, she puts it in her purse, and so it's not given to the bank. So you know you wrote it, and you deducted $50, but the bank doesn't know because it's still in Sally's purse. So we have to include it in the bank statement balance as an outstanding check. Now, check this out. We agree, we balance the checkbook. Basically, a bank reconciliation is just balancing the checkbook. Our adjusted bank statement balance is 1,000. Our checkbook balance is 1,000. We're good. So what we're really trying to do when we get done, our adjusted bank statement balance and our adjusted checkbook balance include all of the transactions. Both sides include all the transactions so that they agree. That's what we call bank reconciliation. The slang for it is balancing the checkbook. Okay, I'd like you to write this down, and because if you can memorize what's in the box, especially this one, it's going to help you when you prepare your bank reconciliation. There are 3 items that can adjust a bank statement balance, and let's memorize them right now. I'm gonna say this once. You're going to say it twice with me, and then that third time you're going to close your eyes and see if you can say it. Okay, adjustments to the bank statement. Let me say it first. Plus deposits in transit, minus outstanding checks, plus or minus bank errors. Okay, say it with me. Plus deposits in transit, minus outstanding checks, plus or minus bank errors. One more time. Plus deposits in transit, minus outstanding checks, plus or minus bank errors. Close your eyes. Plus deposits in transit, minus outstanding checks, plus or minus bank errors. Okay, open your eyes. Now, you should know this, and you're going to be amazed when I show you this really complex looking bank reconciliation, and you're going to see half of it and go, I know what that is. It's child's play because you know these 3 things. Okay, over here, okay, you may want to know what they are and why they're over here. You don't necessarily have to memorize it. But anyway, these are adjustments to the checkbook. These are items that that are included on the bank statement, but aren't readily on the checkbook balance. No, I should have made a note that these items here are on the checkbook balance, but not on the bank statement. That's why we have to put them here on the bank statement. Now, these are on the bank statement, but not on the checkbook. So we've got to put these here. Okay, what are they? Well, interest earned. Let's say, like we saw on that bank statement, interest earned on your checking account. Well, they gave you credit for it. They increased your account, well, let's say $8 on the bank statement, but you'd include it in the checkbook balance because you didn't know how much you were going to earn. So now you got to put it in. How about collection of note? Remember when I said that you could set up with your bank so that the guy that owes you money on a note can actually deposit what he owes directly to the bank? Well, the bank made a collection of the note for you. the bank knows about it. It's on the bank statement, but you didn't know that it happened till you saw it. So you have to add it back in. Now, the debit memos are decreases to your checkbook balance. Service fee. The service fee is on the bank statement, right? They zapped you a service fee. They lowered your checking account amount or your cash account, but you didn't know it, but now you do. So you have to deduct from the checkbook balance. NSF check, non-sufficient funds. Okay, so you deposited a customer check and your bank went to collect on it, and the customer's bank says he doesn't have enough money to cover that. So your bank comes back to you and says, we can't collect on it. We're taking it out of your checking account. So on the bank statement, they're going to reduce your balance. Well, it's on the bank statement, but you didn't know that your customer stiffed you money. So now you do, you have to, reduce your checking account. And of course, then you have plus or minus book errors, and we'll talk about that. Okay. Now, let's go ahead and I'm going to stop the share here, and we're going to go to some handouts in iPad. Okay, so the first one is, I have several here, but this is the one I'm going to show you first. Yeah, you know what? I think it might be better if I did it this way this time, because I want you to see the whole thing. Yeah, that might be better. Okay, now look at this. This is one of those old handouts that I've used last century in the 1900s, right? This is probably could be as early as 1994, 95 even, but it still works. And it's, banking reconciliations haven't changed through the ages. How we do them and how we account for banking transactions have definitely changed with all the new electronic fund transfers and online banking and everything, but the basic principles are still there. Remember when I said that you have two boxes, one for the bank statement and one for the checkbook balance? Well, here is the box for the bank statement. And remember when I said, what are the adjustments to the bank statement? Plus deposits in transit, minus outstanding checks, plus or minus bank errors. Well, there are no bank errors here, but it's just this: plus deposits in transit, minus outstanding checks, and that's it. So just by knowing that, you know all of this. Isn't that amazing? So what we're going to do is we start out with putting in the bank statement balance. And then we're going to add deposits in transit. And then they oftentimes, I think even in Canvas, you're going to do this, get a subtotal, after the additions to your bank statement balance. Next, outstanding checks, less outstanding checks. Well, you're going to list them out, add them up, and put the total here. And then you're going to take this figure minus the outstanding checks to get your adjusted bank balance. It's that easy. Now, next box is the checkbook. You put in the checkbook balance, and then you're going to put in the adds, which would be the credit memos and credit memos, and then the deducts like service charge and NSF check. Now, this is interesting because it says add error on stub for check number 214. Well, errors can be plus or minus, right? In this case, we had an error. So it looks like the error made it so that we deducted 90 cents more than we should have. We must have transposed a number or something. But anyway, we have to fix it. So we're going to add it, and I'll talk a little bit more about that, the add. Now, this should be fairly simple. We have the deducts, NSF check. When your customer stiffed you money, so your bank can't collect on it. They're taking it out of your checking account. They know about it because it's on the bank statement. You didn't know about it until now, so you have to deduct it. Same thing with the bank service charge. The bank, it's on your bank statement. They deducted it. They zapped you the service charge, but you didn't know about it until now, so you have to deduct it. Okay. Now, this is interesting. The adjustments to your checkbook are going to trigger entries, correcting journal entries, okay, to bring your cash balance where it's supposed to be. Now, you don't worry about the adjustments to the bank statement. Why? You let the bank bookkeeper handle their side. All you're responsible for is your side. So we are going to have to account for this. Okay, now I will tell you, then, and this makes it pretty easy, that when you do an add to your checkbook balance, that's going to be a debit to cash. That kind of makes sense, right? If you're adding to the checking account, you're going to debit cash. And any of the deducts, like for service charge, bank service charge, anytime you deduct, well, that's going to trigger a credit to cash, right? Because if you're reducing cash, you have to credit cash. Okay. So basically, when you do these, you just got to, that if it's an add, it's going to be a debit to cash. You just got to know, well, what's the credit to, right? Or on the deducts, it's going to be a credit to cash. Well, what's the debit to? That's the only thing you have to figure out is what the debit is to. So now I'm going to teach you that. On the add error, it's an add, right? So we're going to debit cash for 90 cents. So now we have to figure out, well, why? Well, you got to know what the original check was written for, and then use that. So obviously, I guess, because we know it's accounts payable, that we were paying somebody off. Well, we're going to have to, the credit's going to be the accounts payable. Now, I believe that in your textbook, in an error, it's always going to be to accounts payable. If it's a credit or debit, whatever, but the offset to an error, I believe, is going to be accounts payable. But anyway, you have to be told what it was for, because you can't do it other than that. Okay, so I think that's what that one's about. And we're going to show you how that works in your homework. This is one of the trickier concepts that got me as a student, and I was sweating bullets because I'm not good at that critical thinking. Well, I used to be not good, but obviously I got over it, right? But I mean, when I was in your shoes, this drove me nuts. But I'm going to show you how I overcame it and give you a strategy. So you do it, out pops the answer, and you're good. Okay, let's talk about the NSF check. Well, it's a deduct. So for the NSF check, you are going to credit cash of $200. It's a deduct, credit cash. Well, now you have to determine, well, what's my debit to? All right, you have two choices. Your customer stiffed you money. You can go, boo-hoo, that hurts my feelings. I'm going to write that off to bad debt expense. And you could debit bad debt expense. You're not going to do that. You're going to say to yourself, that deadbeat owes me money. So you're going to debit accounts receivable. Okay. Yeah. Your customer stiffed you money. It came out of your account. Now you got to go after them for it. So you're going to debit accounts receivable, because you're not going to debit bad debt expense and boo-hoo and feel sorry for yourself. You're going to debit accounts receivable and go after that deadbeat. You like my story? I mean, I think I tell it like that. You can't forget that, right? All right. And then the bank service charge, right? It's a deduct. So we're going to credit cash by $1.80. And we could debit bad service charge expense, right? That makes sense. But because it's such a small amount, we're not going to have its own separate account. We're just going to put it in with miscellaneous expense. Okay. So that's kind of how it works. Okay. With that in mind, I would like to do a Canvas handout, quick study 6-5. And let me 6-5. Okay. Hopefully you can see that. I kind of like it when it's big like that. Try something here. Can I make this bigger? No. Well, I can make it bigger. I didn't know I could do that. I guess if it's not big enough, I think you can maybe open it up a little bit. Mine's good. Okay. It says for the following items, A through G, indicate whether the amount will affect the book, a bank or book side of the bank reconciliation, and 2 represents an addition or subtraction in the bank reconciliation, and 3, does it require adjusting journal entry? Okay, so, oh yeah, by the way, this presentation is the 7th edition, but in our book, the 9th edition, it's this 6-5 is now quick study 6-10 on page 267. I'm telling you, I just didn't want to have to redo all of this just because they changed it from quick study 6-5 to quick study 6-10. So I'm sorry. Maybe next semester when I have some time, I'll do it, but it just seems like a lot of work for nothing because it's the same thing. Okay, here we go. Interest on cash balance. Well, it's interest on the cash balance. So apparently the bank knows about it and it's on the bank statement, right? But you don't know about it until you saw the bank statement. So it's on the book. So we need to include it in the book balance, right? The checkbook balance. So we're going to add that interest. Is it going to require an entry? Well, yeah, yes, it will. And you know what, folks? Put this in and maybe even write it as a note. If it's an adjustment to the book, it's going to be adjusting journal entry, right? If it's to the bank, no. Let the bank do its own journal entries, and the bookkeeper is responsible for the bank. We only have to do the adjusting journal entries for the book side. So this interest on cash balance is an adjustment to our checkbook balance. So we are going to add it and we're going to need an entry. Well, what is that entry? An A, I put it down here for you. Debit cash, right? You're going to add it. So you're in debit cash. What's it for? Well, you'd be crediting interest revenue. B, bank service charge. Well, the bank zapped you a service charge. The bank knows about it. It's on the bank statement and you saw it there, but the bank deducted it, but you have not yet. You didn't know it was there. So you have to. So it is a book adjustment, and a service charge is going to be a subtraction to your cash balance. And because it's book, yes, it requires an adjusting journal entry. So what is it? Well, remember, it's a deduction. So it's going to be a credit to cash. And what's the debit to? Well, we could say bank service charge expense, but because it's such a small amount, we are going to put it to miscellaneous expense. Okay. C, a minimum balance charge. And what they're talking about there is for you to get free checking, you've got to keep a certain amount in there at all times. Like you can't go below $2,000. And if you do, they're going to zap you. Well, it looks like you went below the minimum balance, so they're going to zap you a charge. Well, they know about it because they're the ones that zapped you. The bank knows about it. They zapped you. You didn't know about it, so you have to include that as a deduction to your checkbook balance, right? Book, you deduct it. And because it's a deduction from your checkbook, you have a journal entry. What would it be? Again, C, reduction of the cash with credit, and the offset, the debit is going to be to miscellaneous expense. D, outstanding checks. Well, outstanding checks are checks that we wrote, and we know we wrote them, and it's in our checkbook balance. But some of those checks, like Sally's, is still in Sally's purse. Bank doesn't know you wrote that check. So what you have to do, you have to deduct those outstanding checks that the bank doesn't know about against the bank balance. So it's going to be adjustment to the bank, and it's going to be a subtraction from that bank balance. Does that require adjusting a journal entry? No. If it's for the bank, no. The only time that you need an adjusting journal entry is when it's for the book, for the checkbook, right? On your side. Credit memo on collection of note. Well, yes, the bank collected money for you. The bank knows about it, and they actually gave you credit, and they increased your cash balance. You didn't know about it until now. You looked at the bank statement. Okay, so we need to add it to our checkbook balance. So yes, book, add. And because it's book and affects the checkbook, we do need adjusting journal entry. Well, what would it be? It's an add. So we're going to debit cash. And why did we receive the cash? Well, the guy is paying you for what he owes you on the note. So you're going to credit notes receivable. Okay. F, non-sufficient funds check. Well, the bank knows about it because they're the ones that zapped you and reduced your checkbook balance. Why do they do that? Well, your customer stiffed you money. I mean, your bank presented, I keep telling you this so you remember this, your bank went to your customer's bank to collect on the check. And the customer's bank said, he doesn't have enough money to cover that. So your bank comes back and reduces your checkbook balance. They know they did it because they're the ones that did it. It's on your bank statement. You don't know. So you need to make it as an adjustment to your checkbook balance, and it's a subtract. And because it's adjustment to your checkbook balance, you have adjusting entry. And what is it? F. Okay. It's because they're taking money out. It's going to be a credit to cash. And the debit is to accounts receivable. Why? That deadbeat owes you money. He stiffed you money. So you're not going to put it to bad debt expense. Boo-hoo. I'm sad. I hurt my feelings. No, you're going after that guy. So you're going to debit accounts receivable. Okay. All right. Let's continue on. Now I'd like to do quick study 9-11 on page 298. Okay, so this one is 9th edition, and this one is, I wonder, is it better? It'd be easier to see if I did it this way. Well, maybe, huh? That might be nicer to see than the other way because it's bigger, right? Okay, so let's take a look at this on page 268. We have Nolan Company, and it gives us this information. Well, let's go ahead and fill out the header. It's Nolan Company. It's a bank reconciliation, and it's as of June. And you know what? Because it was the same thing as the last one. I'm going to change this because you're the first time I'm doing it with this. Let's do it. Let's make it like 2021. It doesn't really say. It says June 30th, but let's say it's 2021. Okay, the first thing we're going to do is kind of fill it in. We're going to look for the bank statement balance, right? Because we got to start there. The bank statement balance is $21,332. Okay, that's our starting point for the bank statement. And then let's on the second column, let's put in the checkbook balance. And that's 22,352. So that's our starting point. The original bank statement balance and the original checkbook balance. Now we're going to add all of these adjustments, right? These are the boxes I was telling you about before. And then we're going to get our adjusted bank balance and adjusted checkbook balance. So I'm just going to kind of do it weird because this is you have to put it together. And so I've already pre-done it and wrote it. So I'm just going to put it in and explain things to you, but so that you can write from beginning to end. Because if I do it like outstanding checks, then I'm going over here and then doing this. And so let's just go ahead and do what we know. For bank, what are the adjustments for the bank statement balance? Plus deposits in transit, minus outstanding checks, and plus or minus bank errors. Well, you know what, folks? Bank errors are rare because if the bank makes too many errors, you're going to leave them. Most likely, if there's going to be a mistake, it's going to be our mistake. But the bank doesn't make mistakes that often. Sometimes they do, but oftentimes, most of the time, they don't. So really, the adjustments to the bank statement is going to be plus deposits in transit minus outstanding checks. Well, what is our deposit in transit? Well, it looks like we've got one of them. And so put add deposit of June 30th, 4,724. Now, where do I get that? That's D. You see where it says A, B, C, D in your book? That's actually D. So I'm kind of referencing it where I got this information. We have one deposits in transit. Okay, so what we're going to do, add our bank statement with the deposit in transit. Now we got that intermediate figure. Now we need to deduct outstanding checks. And where do we find those? That's in A. It just says outstanding checks as of June 30th is 3,713, right? A. So put that in there. You see why I'm kind of doing it like this? Because it's out of order. So you just can't just go from top to bottom. You have to kind of build it. That's what makes it more difficult. But you guys know how it works. And what are the adjustments to the bank statement balance? Plus deposits in transit, minus outstanding checks. There you go. Then with that, you've got the whole thing on this side. Okay, after you do that, you have an adjusted bank balance of 22,343. Now, we get done on this side, it better agree. Let's work on the checkbook balance. We have 22,352. Now, I'm telling you that we have two additions. One, recording an error, an addition of $9, and of course, interest earned. So where did I get that? Recording error of check? Well, I got it from the instruction C. Now, this one I've got some explaining to do. I know that. I understand that. I have some explaining to do. So let's take a look. What is the explanation? Let's read it. And what is the explanation? C, in reviewing the bank statement, a $90 check written by the company was mistakenly recorded in the company's books as 99. So we wrote a $90 check and deducted $99. We deducted too much. And so we have to add it back. Well, let me tell you, this always freaked me out as a student because do I add as I subtract it, and I'm trying to, logically think it through. I notice when I set it up this way, now this is the way I do it. However you want to do it, you can. If I put down actual check 90, right? The actual check minus recorded as, right? With 99. If I get a minus, I know I have to add it, right? I mean, so even if you can't on a test situation and you're freaking out, you can think it through or just come out with the answer, right? Actual check minus recorded as. If it's a minus, you add it back. Now, logically, it makes sense, right? You wrote a $90 check. So you should have deducted 90, but you didn't. You deducted 99. You deducted $9 more than you should have. So you need to add it back. So if you write that down, that's how I kind of do it. I set it up. And also I tell you logically, if you want to logically put it through too. But hopefully this is going to help you. I know, brothers and sisters, this is painful. Even for me as a student, I go, oh my gosh, but now it's easy. Of course, if you did it for 35 years, it'd be easy for you too, right? But this is how I did it when I was a student. So hopefully that's going to help you. So anyway, so I'm going to add that error of $9. Now, if you look through the fine print, the other add is E, the interest earned, right? So the interest earned, of course, is on the bank statement, right? They know it. They gave us credit for it. We didn't know it, so we've got to add it back. So interest earned of 23. And of course, where do you get that? That's instruction E. Okay, so what they want to do, same thing, take the book balance and all the additions and come up with that subtotal. Now we're going to do the deduction. And if you look at the fine print, instruction B, you see that they zapped us a service charge, bank service charge of 41. So we're going to put that in. And so we take the subtotal there minus the 41, and it comes up with the adjusted book balance of 22,343. And praise the Lord, we make it, right? The adjusted bank balance of 22,343 equals and agrees with the adjusted book balance of 22,343. We're in good shape. That's how we do it. Okay. All right. That's a good one. Let's do one more and then we'll call it quits. I think this last one, we're going to do Jason's bait shot. Now, again, I've asked you to print this out, so hopefully you did. But anyway, same thing. We have this information that's, we have the balance per bank, balance per book. We have our deposit in transit, outstanding checks, and then these other items that are going to affect, looks like they're going to affect our checkbook balance. Okay, I headed up for you and I said balance per bank. We always start with balance per bank. So the balance per bank is 16,506.30. So put that in. Now, what are we looking for? Plus deposits in transit minus outstanding checks. That should equal your adjusted bank balance. Okay, so let's look for plus deposits in transit. Well, there's only one of them, and there it is. Deposit in transit of $4,744. So we're going to put that there. Now, we're going to add it up and get a subtotal. Fine. If it was me, I probably wouldn't do the subtotal, but whatever. I think in Canvas, they make you do that. Now we want less outstanding checks. Well, here they are. And you list them out, and here we go. Just 151 is 350, 175 is 44. Anyway, it's a copy job. Just take these and put them in the inner column because we're going to add them up. So we take all of our checks. These are the check numbers, and here's the amounts. We add them up, and we get the total. There it is. So then we take that subtotal minus our outstanding checks, and now we've got our adjusted bank balance. Okay. The next thing we're going to do is do the other side. We're looking for the second box, if you will, the balance per the checkbook. And notice that that is right here. The balance per the checkbook is 22,164.08, right? So remember, we're starting out with those two, just like before. If you want to see, we start out with the balance per bank, 16,506, put that there, and then the checkbook balance down there. And then we make our adjustments. So this is box one, the top box, right, for adjustments to the bank. This is a bottom box for the adjustments to the book. So we're working on the adjustments to the book. Okay, so now we want to do the adds. Well, what are they? Let's take a look. You know, we've already accounted for the bank balance and the outstanding checks and the deposits in transit. Now we've got these things are the ones that affect the checkbook. We have a service charge. Well, that's going to be a minus. Non-sufficient funds, that's going to be a minus. Monthly interest earned on the account, that's going to be a plus. So let's put that in. Oh, you know what? This error, we looks like we wrote a check for $1,200 and we only, recorded it as 129. So we'll get to that. Well, we know that we're gonna, what are we gonna do on that? We didn't deduct enough, right? We should have deducted $1,291, but we didn't. We only deducted 129. We didn't deduct enough. This is going to be a deduct. Okay, but we'll go that later. Right now, the only add is going to be this interest earned, right? Monthly interest earned, 34. So we're going to, from our checkbook balance, we're going to add the monthly interest earned. Now we get this new subtotal. Now we're going to do the minuses. Well, like I say, there's two of them. Actually, there's three of them. All three of them are minuses. We got the bank service charge. We were zapped. We have to put that. We didn't know about it until now. The bank zapped us a insufficient check, non-sufficient funds check. Take that, minus that, and we know that this is a minus. I guess let's put in a bank service charge and non-sufficient funds, because that's the probably easiest one right now. Okay, so less bank service charge, $65, then less the non-sufficient funds check, $179. Okay, let's now go tell you about the check error. This is what I want you to know how to do, because this is the hardest part, at least to me. You guys might think it's easy, but it wasn't for me. It is now because I've done it so long. Anyway, you take the actual check minus recorded as, and you get a number. If it's positive, you deduct. If it's negative, you add. Well, so here we go. Actual check was $1,291.20 minus recorded as $129.12. That's a positive $1,162.08. If it's positive, we know we want to subtract. Now, that's just how I did do it in your little mind, how you like to think. You come up with your own method. That's how I did it. Even if I don't really fully understand it, I could do it. I'd get the right answer. But now, I'm going to tell you intuitively how to do it. I got freaked out on tests, so I would lose it. So I had to do it this way, so just to make sure I get it right. But intuitively, check this out. Your check was for $1,291.20. So you should have deducted that amount. You only deducted $129.12. You didn't deduct enough, right? You should have deducted $1,291 and you only deducted 129. So you didn't deduct enough. So subtract it. That's how it works. Anyway, put that amount, error in checkbook, and I told you how I did it, is 1,162.08. Add all of our deductions. There you go. And you take it from that subtotal minus the lesses, right? Subtractions. You should get the adjusted checkbook balance of $20,792. And guess what? We balanced the checkbook because our adjusted bank balance of $20,792 equals our adjusted checkbook balance of $20,792. Okay. All right. Any questions about that? All right. If not, I'm going to stop the share. And you know what? Gosh, I think I held you a little bit over last time, but this time I'm 5 minutes early. So, but I'm done. So there's no need to keep going on. I think I told you what I needed to tell you. So on Tuesday, we're going to be wrapping up chapter 6, and I'll be going over internal controls, and I might even give you a little test review, right? Just kind of get you going, because I think our test is a week from today, isn't it? I believe it is. So anyway, if there's no other statements or anything you like to bring, I think we should just adjourn. Anybody? You look good, Becky. Okay. Thank you. We'll see you later.